In this video I'll be going over some of the special property transactions found in Chapter 12. I've also, as I normally do, published a video that demonstrates some of the problems in the learning objectives of this chapter. And then this week I've also provided a template to assist you in doing the problems in Connect. If you decide to use it, you certainly don't have to. If you'd like it for check figures, for example, it's available to you for this more challenging chapter. So like-kind exchange, as we'll talk about, is an exchange of, for example, business assets that are used either for business or held for investment with another business. And the idea here is that if two businesses exchange similar kinds of property, they can defer the recognition of any gain that they normally would have had to recognize had it been a sale. Certain kinds of assets for the business are not eligible for like-kind exchange treatment. Inventory, stocks and bonds, debt instruments, certificates of trust, and then interest in partnerships do not qualify. So their gains or losses would have to be recognized right away. And dealers may not engage in like-kind exchange treatment. In other words, they can certainly exchange property, but they'll have to recognize gains, and that may result from the exchange. So what is a like-kind asset? These assets are similar in nature or character and of the same depreciation class. For example, they might both be 5-year property or 7-year property. The quality of the assets exchanged does not matter. So a farmer may exchange his combine for another farmer's tractor. This would qualify generally as a like-kind exchange. And so once they exchange the two assets, and we'll go over some basis calculations, they don't need to recognize a gain on this qualified like-kind exchange at the point of the exchange. Now later, when they sell these assets to an independent third party, yes, then if a gain results, the gain would have to be recognized, but at least not at the point of the exchange. We'll be talking about boot property. This is extra consideration that's given or received, and it's given as to kind of equalize the economic value of the exchange. For example, when I mentioned the farmer who exchanged the combine for the tractor. So if the combine had more value, then the counterparty might kick in some cash just to kind of equal the transaction. The very fact that one of the parties in this like-kind exchange received boot, this extra compensation, means that it's possible that part of that gain on the part of the party who received the boot may have to be recognized during the exchange, this like-kind exchange. So the boot often triggers the recognition of some gain by the party who received the boot. So how much of the gain is recognized then in a like-kind exchange? Well, the fair market value of the boot received or the realized gain on the exchange, whichever is less. And as I said earlier, receipt of boot causes recognition of gain, and giving the boot does not. So we have this calculation then. All right, we've exchanged these assets. What is our basis of the asset we just acquired in this like-kind exchange? So here's the formula given in the book. First of all, you start with the basis of the property given. Then you add to that any boot given to the other party to make it an equitable exchange. Then you'll add any gain recognized, because if it's recognized, it means you've paid tax on that part of the gain already. You don't have to be taxed twice. So you get to add that to the basis. And then it would be reduced by any boot received, because in a sense a boot is a partial liquidation of the asset, and that reduces the basis. The objective, of course, is we want our basis to be as high as possible, because that means when we sell it later, we'll have less gain to recognize. Or the alternative calculation of the basis is the fair market value of the property received less the deferred gain. They should result in the same basis. Again, deferred gain means that it's a gain that was realized but is not currently recognized. So the exchanges don't have to be simultaneous. If you're exchanging like-kind assets with somebody else, another business for example, one party has 45 days to locate replacement property, and then 180 days to receive the replacement property, actually consummate or complete the exchange. Any liabilities that are assumed by either party is considered boot. So if I exchanged again my tractor and I owe $10,000 on it, and the other parties agreed to take over that payment requirement of the $10,000 and pay it off for me, that's like the same as if they handed me the $10,000, for example, of the loan that I'm relieved of paying now. So an involuntary conversion results when property is destroyed, sold, and condemned, and the taxpayer receives similar property or proceeds. Talk a little bit about this. For example, if an insurance company remits insurance proceeds because a catastrophic event occurred and property was destroyed, these are the proceeds that they're referring to, an example of those proceeds. We defer the entire gain on an involuntary conversion when the replacement property purchased is equal to or of greater value than the amount of the proceeds. So my shed was damaged and the amount of the total damage was $25,000, and I received proceeds of $25,000, and I used that 25 grand to build a new shed, for example. As long as I've done that, there is no gain to recognize on this involuntary conversion. In my example, I did replace it with a shed just of similar kind or service, so I'm fine, it qualifies then. What qualifies though is more restrictive than a like-kind exchange. It's got to be pretty similar, and real estate or real property can only be like-kind. Replacement period, I have to get that shed built within 2 years after the close of the tax year, or 3 years if it was real estate for business property. So if it was a commercial building then used for businesses, then I'd have 3 years to find another building or replace this and build a new commercial building. Otherwise, it's 2 years after the close of the tax year to actually make the replacement. So the calculations for basis for involuntarily converted property is similar to that we used for like-kind exchange. We start with the basis of the converted property, and then we deduct any money that we received and did not use to replace the destroyed property, for example. And then we add any money reinvested in excess of proceeds. So if we needed more money than the insurance company paid us for the damage, then that adds to our basis, because we, in a sense, have more skin in the game, right? We've added more value to this replacement. And then if there's any gain that is taxable or recognized, that adds to our basis, so we're not taxed twice again. And then we would reduce it by any loss received, because any loss received and recognized, we would receive a tax benefit. We can't receive the tax benefit twice, so that reduces the basis. Holding period of the replacement property includes the holding period of the property converted, so that'd be the initial shed, for example, in my case. That basis of the shed that was destroyed becomes the basis of the new shed that I built, just as previously discussed. Another topic or special property transaction that was discussed in Chapter 12 is installment sales. This is a disposition of property where at least one payment is to be received after the year of the sale. And so, in a sense, it's like a financing of a sale. And so this financing has three components: the interest on the fact that payment for whatever was sold is being delayed, return of basis, and then gain on the sale. Right. One of the things we need to know is what is the gross profit, because in order to calculate the gross profit percentage to apply it to each payment for taxation purposes, we need to know what the gross profit is, which would be, of course, the sale price minus the adjusted basis. And then we would take that gross profit and divide it by the contract price to get that gross profit percentage. So we'd apply that gross profit percentage to each payment to determine in part how much is taxable. Dealers, like they cannot use like-kind exchange, we said earlier, they also cannot use the installment method for tax purposes. It also can't be used for the sale of publicly traded stock. And if there is any depreciation recapture on the sale of the asset that was as being financed under an installment sale contract, any depreciation recapture must be recognized in the year the asset is disposed of. That is, you cannot include in the contract the amortization of the recapture of depreciation. That's got to be accounted for all at once in the year of the disposition of the asset. Another special transaction topic that was discussed in Chapter 12 is the fact that the sale of primary residence can receive special benefits from the IRS or from the government, and that is that married taxpayers, for example, can exclude up to $500,000 of the gain of the sale of their personal residence, and it's $250,000 for single folks. And this is an exclusion, not a deferral of gain. So each transaction, each sale of the home, as long as it's not done within 2 years, each sale of the home, then the owners get this exclusion of up to $500,000 for married of capital gains on the sale. So to qualify, there's an ownership test and a use test to qualify for this exclusion. First, you have to have owned the home at least 2 years and then used it for at least 2 years, and that these tests do not have to be continuous. I mentioned earlier, you cannot, for example, flip a home. You cannot sell these more frequently than every 2 years and still qualify for this exclusion, with some exceptions, like, for example, employment reasons, health, sometimes divorce. Here you could prorate the $500,000 for married based on the number of days you lived there, divided by the 2-year period, which is 730 days. But only for these specific reasons can you prorate the exclusion. Another special topic transaction discussed in Chapter 12 is related party losses and wash sales. So in the tax code, we handle transactions between related parties a little bit differently, because it's not necessarily considered an arm's length transaction. And so family members could collude if they wanted to and attempt to circumvent some of the tax code tax recognition rules. So we have some rules that are set up. Related parties, they include family members, or if an entity or a person owns 50% or more of a company, for example. And then constructive ownership rules apply. That means that, if you don't own the property but you control the folks who do, you have a controlling influence over the owners, then you are constructively owning that property as well. A disallowed loss then does not affect the basis of the property to the buyer. A wash sale means that you have sold that asset and then repurchased it within 30 days. If you've sold an asset and then purchased virtually the same kind of asset within 30 days, from the IRS's point of view, the ownership really has not changed in this asset. And so the loss that results from having sold it and then repurchased the very similar asset within 30 days is disallowed. That is to say, you may not deduct it on your taxes. If you have any questions on these or any of the rather advanced topics in Chapter 12, please let me know.